I'm going to go through my Black-Scholes options pricing model. And if you want a copy of this, just email me. I'm going to use Tesla as an example. So the current stock price, $333. I'm using E-Trade, but you can use any website that has options. So you can see the current stock price, pretty much $333. And this is a screenshot of Tesla's December options. So in E-Trade, you could just type in the ticker, you'll get this screen, then hit options. It defaulted to 1129 options. You can pick December 6th, December 13th. I want to go out about a year. So that's why I picked December. Here's December 19th. I just took a screenshot of this right here. So we can use any strike price. I just picked 360. That's why I put 360 in here. The risk-free rate, it's currently 4.25%. I put the website right here I used, the 10-year treasury rate, and 4.25%. When it says risk-free rate, that's like the guaranteed return you would receive because a US Treasury note is pretty much guaranteed. Once you start taking some risk, you might get a higher interest rate, 6, 7, 8, 9, even 10%, but you might not receive your principal back. The next cell is the expected life of the option, and this is in years, so it's roughly 1 year. That's why I picked December. If you want to go out 6 months, say until May or June of 2025, just change this to 0.5. And then beta, you can go to Yahoo Finance or any website. I'll just stick with E-Trade since I'm on here already. The reason I'm not using Yahoo Finance is because their options weren't loading. That website's been really wonky lately, ever since they did the upgrade. So right here is beta 2.8. That's the volatility of the stock. So I put 2.8. And you can put the dividend here. They don't pay a dividend. And if you hit F2, you can see the formula if you want to learn how it works. In a future video, I'll explain the mechanics of the formula and how it works. So based on the parameters we entered, the option is worth $32. You can see it's trading around $71 or $72. So you would not buy the option. The more volatile a stock is, the higher the option is going to trade at. Say their beta was 4. Now the option is worth $48. It's still not 71, so we wouldn't buy it. Let's say Tesla stock went up. It went up to 360, the exercise price. Now it's pretty close. It's at $64. You should definitely play around with all these inputs to see how option prices move. What if you wanted to buy the 280 strike price? Let's change this to 280. Now the option's worth 87. It's trading at about 105. It's good to look at different stocks and plug in the variables and see if any are undervalued. Option trading is much more volatile than regular stock trading because the market is not that big for options trading. A stock like Tesla trades millions, maybe tens of millions of shares each day. Options, just a few thousand, as you can see here on the open interest. And the volume is even lower. Open interest are how many contracts are open in the market. So the more open interest, the more interest in that particular option trade. So open interest is always going to be higher than volume. Let's go to March 2025, only a few months out. If the strike price is close to the actual price, there'll be a decent amount of open interest and some volume. If you go really far into the money, like $55 strike price, there's no volume, 65 open interest. And if you really go far out the money, like well above $400 or $500 a share, you can see the open interest and volume gets smaller. Although it's 700, there's a lot of open interest. And these people are probably playing around with their Black-Scholes Excel model so they know how to price the option. Maybe with this Excel model, you can identify options that are good value and make some quick money. I'm happy to send you this Excel file. Just email me. And if you want to learn how to value a stock using a discounted cash flow model, check out the video in the top right corner. Thanks for watching.